Hello, I'm Gary Orff, Chief Investment Officer. Many clients this time of year ask the same question: how should we think about markets after another strong year like last year for stocks? And our answer to that question includes both optimism and caution. Let's start with the positives. Earnings expectations for 2026 look supportive. For several years, a small group of large technology companies drove most earnings growth. Those companies still matter, but at the same time, analysts expect earnings growth to broaden to include other companies as well. So large companies outside of technology and smaller companies may start closing that earnings gap. A wider earnings base often supports healthier market participation. So the Fed's monetary policy also adds support. The Federal Reserve continues to respond to data, especially inflation data, and inflation data has shown signs of stability and slight improvement in some areas. This could lead to lower interest rates, and when rates move lower, that tends to benefit stocks and bonds. Futures markets, though, remain unsure about just how much rate relief will show up in 2026. Even so, the direction of policy matters, and it appears for now to point toward lower interest rates. The U.S. economy also remains resilient. Growth runs near 3%, pretty healthy. Recession concerns have eased, and so taken together, these factors support owning stocks. Market pullbacks do happen, and they can happen often. Knowing this, we still believe appropriate equity exposure makes sense unless we see negative changes in earnings, inflation, or economic growth. Now let's talk about the risks. Strong growth can bring pressure. Faster than expected earnings growth or economic strength could push interest rates higher, and higher rates often weigh on stock and bond prices. Consumer spending also deserves some attention. Spending drives U.S. economic growth. Recent growth has relied more heavily on higher income households. So if spending there slows, economic momentum could suffer. Another risk lies in market concentration. The 5 largest stocks in the S&P 500 now represent about 30% of that index. This is evidence that overall, market results have relied on fewer companies than in the past. Regarding some of these larger names, valuations have also run above long-term averages. Some of that premium valuation reflects their strong earnings. Going forward, however, higher prices likely rely more on earnings growth and less on rising valuation multiples. Regarding market projections, strategists project that this year you could see the market perform in line with earnings growth, which is expected to be about 14%. Some expect lower returns than that, though, if valuations compress. Forecasts often change, though, and we place limited weight on them. One point about forecasts stand out. Few strategists have projected a market decline in 2026. Usually there are a few. This year, not many. And that kind of groupthink deserves some caution. And then, of course, you have the potential for geopolitical risks. We're encouraged by the ongoing projects technologically and its impact across several industries. We also recognize, however, that we have not experienced a meaningful pullback in stocks since early 2025. Another pullback would not surprise us, but we don't try to time it. History shows that timing efforts carry low success rates and they're costly. Our focus stays the same: long-term discipline, diversification, and decisions tied to your financial goals. Thank you for trusting us with your financial planning, and we wish you a healthy and prosperous year ahead.